will not get into too much intricacies about it, but my basic idea is to make you understand how these gamma levels are going to help you. You do not need a lot of technical knowledge about options and stuff, but just to get to gamma, I will say what an option is. Suppose your SPY is sitting at 500 and you're expecting the SPY will move to 510 in the next 2 weeks. So you say that, okay, I am buying a call contract which will say that I am buying a call contract with a strike price of 510 and the expiry date of that contract is after 2 weeks. That is what we call as a call contract. Whereas on the put contract, you will buy a put contract when you are actually expecting the market to be bearish. So when you are expecting the market to be bearish, at that point of time, what you do is you buy into a put contract, and similarly you say this is my strike price where you're expecting the price to go, and this is and then you will have an expiry date. Now think about it. You are buying these options, right? From whom? You don't know. The market maker is responsible to match these things up. So if you are buying a 510 call option after 2 weeks, there has to be a counterparty who is willing to sell that contract to you, who is willing to underwrite that contract for you. Correct? And if someone is not underwriting the contract, what will happen? Your trade will not be executed, and you will say that this is an illiquid market. In order to maintain this liquidity in the market makers become the counterparty if they do not find a matching counterparty with the same trade who is willing to sell it to you and you are willing to buy. Make sense? So if you're trying to buy something, if you're trying to buy, say, some vegetable, you're trying to buy a cabbage. Now, if none of the stores around you are selling the cabbage, where will you buy it from? Then you will say that, okay, this cabbage is a commodity which is not quickly available and it's too expensive, because whatever is not easily available will become expensive. Illiquid markets will become expensive. Correct? So that is why the counterparties, in order to the market makers, in order to provide you with the liquidity that is there in the market, if you're saying I will buy a 510 call option for XYZ expiry date, no one is going to stop you. The market makers will become the counterparty and they will sell it to you. So as a counterparty, what happens? A position goes into their own books. So when a position is going into their own books, now think about it. You are saying, I am buying at 500, I am expecting 510. Now, if the market actually goes up to 510, the increase in the premium of the contract is what the market maker has to pay you back. So they are at a loss. Now, market makers do not want to make that loss. So that is why they do something called delta hedging and gamma hedging. But before we go into the hedging part, let us talk about what is delta and what is gamma.
Yes, yes.
Now, let's move on. What is delta? Now, delta is the first derivative of price. The first derivative of price is saying that if my underlying, which is pi, say I have bought the contract for $2 per contract, which translated into $200. Now, if my delta is 0.2, for every dollar movement of price from say from 500 to 501, my contract price will go from $2 to $2.20 because my delta was 0.2. So my $200 contract, which is my lot, one lot has 100 contracts. So my $200 contract has moved up to $220. Right? So that is your movement, and this rate of change of the price of the contract with every dollar move in the underlying is what is called as delta. Now we know delta. What is gamma? Gamma is the second derivative of price or the first derivative of delta. Think about it. If any one of you have done derivatives, think about it. Dy by dx. So it is the same thing. We are creating the first derivative and the second derivative. Think about motion. With motion, we have speed, and with speed, we have acceleration. So delta is the speed, whereas gamma is the acceleration. It is the rate of change of delta with $1 change in the underlying. Just think about it from that concept. If something is moving, there is momentum, and that speed, the this thing becomes your acceleration, right? So you have speed, you have acceleration. Speed is the rate of change in the position of the car, and acceleration is the rate of change at which the speed is changing, right? So this delta and gamma, this is the rate of change of delta with every $1 change in underlying. So when we are saying that 1 to 60 miles in 1 hour or in 1 second, we are actually talking about speed and acceleration. Your speed is 60 miles per hour, but your acceleration is 60 miles per, that will be a second derivative. Right now, we'll have to see, okay, from 60, I went to 80. How much time did it take? How much time did it take from the speed to get from 60 to 80? That becomes your acceleration because you accelerated, right? So that is what is delta and gamma. Delta is the rate of change of the option contract price with every $1 change of the in the price of the underlying. Gamma is the rate of change of delta with every $1 change in the underlying itself. Okay. Long option contracts have positive gamma. Short option contracts have negative gamma. A positive gamma position benefits from large price moves. When you are in a long contract, the price movement needs to be large for you to get to that profit. But the negative gamma positions, even a small price movement, it will give you a lot of profit. But options have I do long-term options. I do not do short-term options because along with this delta gamma, there is something again called theta, where the time factor comes in. And especially if you're doing your intraday options and the price starts dancing around in the middle, that is the point of time you should say, okay, I should stay away from the market, because that theta actually eats into, actually reduces your gamma. That is the effect that it has, because the closer you are going towards the period. So suppose you will be writing an exam. When you are 6 months away from the exam, you're saying, I have a lot of time, it will be done. When you are 2 days away from the exam, you do not have that time leverage anymore. So the price of that thing has now come down. So the price of that contract is being pulled down at this point. That is why I prefer not to play intraday options. Okay, so this is how the market works. Okay, so long option contracts have positive gamma, short option contracts have negative gamma. A positive gamma position benefits from large price moves, while negative gamma position benefits from small price moves as well. Okay, now first thing is open interest. What is open interest? Open interest at a specific price can be a combination of the number of call options and the number of put options that are there at that point of time. Say, if I am talking about a price, say at this point of time, let's say 6,100. So if I will go back to my data. I'll show you how we are looking at the data right now, but there are other ways of looking at data as well. I'm just trying to get the easier way out so that I do not have to do the calculations myself. Open interest is at say at 6,100 for the expiry of next week's end. There are there are call options that are open for $200 million, and there are put options that are open for $200 million. So your open interest at 6,100 is $400 million. Okay, so that is basically open interest at a given strike price. What is the call amount of call options? What is the amount of put options? That defines your open interest at a specific price. Every price has its own open interest. Gamma levels are, oh, what a spelling. Gamma levels are price levels where there is considerable positive or negative gamma accumulated based on the market positioning and open interest. So now you're looking at, okay, at what price I have the maximum positive gamma and at what price I have the maximum negative gamma. These are important levels as great deal of trading activities occur here and thus influences price movements of the underlying. Again, I'm not going into the details, but what happens is I already told you what is the role of a market maker, right? So what happens is market makers use delta hedging to manage their risk. They're using the delta to manage their risk, where they buy or sell underlying assets to offset the changes in delta caused by the underlying price movements. they neutralize the market positions, thus offsetting any directional risk in their own books. So if they go out of business, where will you trade? Who will be your counterparty? So they cannot go out of business. Their systems are so sophisticated that they will do all these calculations in fractions of seconds, and they will keep on buying and selling, buying and selling, buying and selling. Right? So that is why the gamma levels become so important. Now, what is JEX? The delta exposure, how much exposure you have on delta. Again, I'm not going to the mathematical things and everything. There's a lot of mathematics under this. The delta exposure is called DEX, while the gamma exposure is called JEX, because you do not need to know all these mathematics if you are looking at this. If you can understand how we are defining support and resistance, that is good enough. DEX provides insights into liquidity in the market and direction. JEX measures the market volatility. So DEX and JEX, some people call it GEX as well. In a positive gamma environment, the market makers will buy when the price of the underlying drops and sell when the underlying goes up. In a bigger picture, I'll show you how to look at the total uh, the total gamma value and everything. But in a positive gamma environment, the market makers will buy when the price of the underlying drops and sell when the underlying goes up. In a positive environment, always expect that we are in a kind of a trading range, and the trading range may not break out. You have to believe that. If it breaks out, go back and check. Did my gamma turn into a negative zone? If not, then it keeps on moving in the same direction. I mean, it will come back to the trading range at some point. This helps them to do the delta hedging at important gamma levels. Now they will hedge their delta, but at those levels of the gamma, right? Thus, positive gamma environments often gives rise to trading ranges. In a negative gamma environment, now this is where they will follow the trend. If the market is coming down, they will bring it down. If the market is going up, they will keep on buying. In a negative gamma environment, the market makers will follow the trend, and they will keep selling the lows and buying the highs. Now, what is a gamma squeeze? We have heard of squeezes a lot of times, right? This is how it happens. Now, one perfect example is, which is the stock that squeezes most in the market? Rishi, you should be able to say this. There's one stock which squeezes a couple of times every year.
GM.
Now, GameStop.
I thought the game same thing.
Oh,
GameStop.
you said GM. Okay. Yeah, GameStop. So what happens is these are pump and dump stocks, right? People get together and say, okay, we will
AMC
buy.
also. AMC another one.
AMC, another example. Okay, so what they do is they buy huge quantities of out of the money stocks. As the price, they buy huge quantity of out of the money calls. Like if the price is at $5, they're buying $50 calls in huge quantities. Now what happens? The market sees, people like you and me see that, oh, there is a big call order flow, so the price will be going up. Looking at that, people like you and me also start buying into it. There are some people who are buying into the actual stock as well. Now everything is making the market go up. Now, in a negative gamma environment, as we know that the market makers will actually follow the trend, they start buying so that they can offset their losses. As the market is going up, they have to offset their losses, and especially when the gamma environment is deeply negative, they keep on buying. So there is a cumulative effect. So there is a lot of buyers coming in who are buying into call options. There are a lot of buyers coming in who are buying the underlying, and there is a lot of market makers who are coming in who are buying the stock in order to offset offset the losses in their books, so that they are not red at the end of the day. And that cumulative effect creates this huge move to the upside. That is how the gamma squeezes work. And when you are looking at the gamma flips and you can decide on the direction, most of the days the gamma does not flip, but most of the days it does as well. Okay, day like today, it was a gamma flip day. It was not actually a gamma flip, because till yesterday night the gamma was positive. Today morning the gamma completely turned negative right after 9:30. It was almost $7 billion to start with, and then it came down to -10 and -11, 12, somewhere there. Okay, so that is how these gamma squeezes happen. So in a negative gamma environment, the market makers will follow the trend and they keep selling the lows and buying the highs. Okay, now what are the important GEX levels that you need to look at on a regular basis? Strike price of highest positive gamma. What is the strike price where we have the highest positive gamma? Strike price of the highest negative gamma. Where is the highest negative gamma? What is the aggregate gamma? Okay, we have the, as I was saying, you look at the open interest again. So if I have 400 million, 200 million and 200 million, my total open interest is 400 million. Now, if that is one set of data, that is my aggregate gamma. So we will find out the strike prices for the highest or highest three or highest two absolute gammas. Where do we have the highest open interest? That is that price where you have the 400 million. That is the highest open interest. Gamma threshold, strike price where gamma flips to positive from negative or to negative from positive. That's the flip zone. Strike price of highest call open interest, strike price of highest put open interest. So these are the different data that you need to find out. So let me tell you what is the source of it. There are several vendors. Now, these data you will not find free. If you find free, you will have to go to the options chain in any one of your whichever broker you are using, whether it's Schwab or it's TOS or it's Webull or whatever. You have to go to the options chain. You have to do the mathematics yourself to find all these things out. Rather than that, these guys are actually providing you the whole thing in a very simple way. Now, see, the whole market. This is the gamma exposure. So the whole market is in a negative gamma zone, right? The whole market is in a negative gamma zone. Now, this is SPX. SPX being an optionable instrument, you have options there. ES is not optionable, so you do not find the gamma exposure based on ES. However, if you are looking at this, if you know how the difference between SPX and ES, like for example, this was 6,000, that in the current scenario will translate to 6015 on ES. So you'll have to check that out. You'll have to check out at the close of the day what happens. But remember, when the contract is almost nearing an end, the spot price and the futures price will converge. That's the concept of futures as an instrument. Whenever the futures contract is coming to an expiry, it will actually converge with the contract price that is there, that particular contract. And but the next contract, the next available running contract will still be at a higher price, and that is the rollover gap that we get. Okay, so let's forget ES now. You add 15 to it, you'll get those lines. So this area, this is what? This is 6050. So that means 6070 now, which came down. Now this is on the call side, right here where we close at 6013. Right here you have this is one, this is one. These are your major resistances, and if we fall below 5950, see, there is nothing here today. After this 70, this 5970 on this one, 6010, no, right, this one. After we had the 6050, see, there was nothing was there. The next support you have right now is at 6010, which converts to 6030 or 6025, where we already reached, right? So that provided some kind of support. But if we are breaking down now, and as long we are not recovering this again, this will be the next target on the downside. But if it recovers from here and gets above the close of the day, there is a high possibility, because of this negative gamma environment, the market will shoot up and it will come directly to the 6070 level once again, right? And then see, this is your 6015 level on ES. If we get above this, it will come here. Now this is where the squeezes happen. If you get over this, it will squeeze up to this level, or maybe whatever level will be updated on Monday morning. So this is how we find the gamma exposure. Now look at this. You can find the maximum call gamma and the maximum put gamma exposures this way. You have a call open interest by strike. So this is the biggest open interest area, 6115. That will be a very good area of support and resistance. And then you have the total exposure by contract and all those things, total call gamma exposure, total put gamma exposure. You have all those things. So still, from here also, you'll have to make some adjustment. You'll have to understand what this chart is telling you, and then go and print it on your own. Go and mark these lines on your chart. Other than that, there are some other vendors as well who provide the data in a slightly different format. Let me show it to you. Yeah, so this is another vendor. This is called Unusual Wells. They actually define it in a slightly different way, right? And then you have this particular one, the bar chart. Bar chart also, for every stock they will give you these support and resistance points. If you do not want to get bothered about anything, you can just use these as your support and resistance points for any stock or anything. Okay. So this is that side, unusual wells. We are looking at a data which is 2 days old because I'm not signed up here, but you can look at all these things here. All these data items are here. There are multiple things, right? Do we have gamma here? Options data. It is somewhere. I saw it, but I cannot find it out right now. ETF overview. No, it's not here also. So we will find that out sometime. But yeah, there are several vendors who are giving you these data, and all you have to do is find out those data points that we talked about, and you can mark them on your chart. That's all you have to do, right? And then you know that if you have, say, 60/70 is a put wall that is below my current price. That's the maximum buyers and sellers who are there. Okay, after that, if you do not have anything, and if it fall below 6070, it will squeeze down. As long as there are not enough buyers to stop that, it will keep on squeezing down. Similarly, on the upside, if you get above the call wall, it will migrate to the next call wall. As long as this is not broken down, as till that point of time, people will start migrating toward, or the price will start gravitating towards that particular next area where the price is there. So that is how you need to take a look at it. When you get a pullback the next day, say it did not go to the next area, but you're expecting the price to go back there. When you're getting a pullback, now see if it is hitting the put wall, or even before that, it is actually coming, turning, getting above that price, and keep moving to the upside. Right. So this is how we define these important GEX levels or JEX levels, whatever you want to call it. And based on that, you can these are the concepts, right? And this is the JEX theory. This is JEX theory in two lines. Okay, you do not need to know more than this. Price of the underlying will move towards the highest call strikes with highest gamma exposures, which act as a supply zone. May act as a supply zone, but if we go above it, you may actually squeeze that day. But that is a very good area to take profit and look for a reversal. Similarly, price of the underlying will move towards the highest put strikes with the highest gamma exposure and can act as a demand zone or a reversal in that case. But again, that's a very good area to take most of your profits. And then if you break it down, you can add on to your positions once again. Makes sense? Any questions? This is the last.